Welcome to the Deep Dive. Today we're jumping into the Crocs Inc., that's CROX, third quarter 2025 earnings call. It happened pre-market October 30th.
And it was, well, quite the release. You had this huge headline beat, really strong numbers against estimates.
Yeah, absolutely. But then the market just didn't buy it. The stock closed down 2.5% that day. Instant skepticism.
That contradiction, that's exactly what we want to unpack here. Our goal isn't just, reading the numbers. We want to get into the strategy, the context.
Right. Why did investors look past that peak? What's the real story with the HEYDUDE cleanup everyone's talking about?
And also, what does their, frankly, impressive financial firepower demonstrated this quarter actually mean for 2026?
Okay, let's start right there with the results, because like you said, just looking at the headlines, it looked fantastic. Non-GAAP diluted EPS, $2.92.
Which was, what, 53 to 56 cents above consensus estimates? I mean, that's not just a beat, that's a massive beat.
Exactly. And revenue too, right? Came in just under that billion-dollar mark, $996.3 million.
Yep, beating consensus by about $35 million. So on paper, you'd think, wow, home run quarter.
But, and this is the big but, the market grabbed onto immediately. These numbers, despite beating this quarter's estimates, were actually down compared to last year.
That's the critical context. That non-GAAP EPS, even at $2.92, was down almost 19%, 18.9% year over year, and total revenue down 6.2% year over year. So you get this weird picture, beating expectations now, but the overall trend is contracting.
Right.
Precisely. The market saw that slowing momentum, looked straight past the Q3 beat, and focused entirely on the future guidance and, let's be honest, the HEYDUDE risks.
That stock drop really says it all, doesn't it? Investors voted with their feet, looking ahead.
Absolutely. Okay, so let's dig into the margins, because this is where things get interesting. There's some real underlying strength, even with headwinds. Gross margin was 58.5%.
Still pretty strong, but down 110 basis points from last year. What was driving that pressure? Okay, the big headline here, tariffs. Management was really clear on this. Tariffs were a 230 basis point headwind. Wow, 230 basis points, that's significant. It is. And here's the kicker. That was actually 60 basis points worse than they had originally planned for or anticipated. Okay, so let's make sure everyone gets this. They took a 2.3 percentage point hit from tariffs, worse than expected,
Right.
and still delivered a 58.5% gross margin. Doesn't that actually suggest the core business is becoming more profitable underneath?
That's exactly the point. If you mentally back out that unexpected tariff hit, their gross margins would have actually gone up year over year.
What drove that underlying improvement then?
Lower product costs they negotiated and higher average selling prices, ASPs, across both brands, actually.
Okay, so structural health is there. What about operating margin?
Operating margin landed at 20.8%. Now, that was also down year over year, about 460 basis points, but importantly, it was ahead of their own guidance.
So even with the revenue dip and the tariff surprise, they managed costs well enough to beat their own profit targets.
Correct. It shows discipline even during a contraction phase.
Which leads us nicely into the brand performance, because it really is a tale of two brands right now, isn't it?
Completely different stories. Let's start with the core Crocs brand. Revenue there was $836 million. Down, but only slightly, 2.5% year over year.
And management kept calling this strategic discipline, particularly in North America. What does that actually mean?
It means they pulled back intentionally. If you look at the channels, direct-to-consumer DTC was actually up 2.0%, hitting $472 million. That's strong.
So where they control the experience and price, demand is still growing.
Exactly. That DTC strength offset the weakness in wholesale, which was down almost 8%, 7.9%, and that wholesale drop was planned. They cut back on receipts, especially for the classic clog, and reduced digital promotions.
So choosing profit and brand health over just pushing volume through wholesale.
That seems to be the play, and it looks like it's working okay, especially when you see the international picture.
Right, they mentioned broad-based strength internationally, China, Japan, Western Europe doing well.
Yeah, finding growth outside the more, perhaps, saturated North American market.
Okay, now pivot to HEYDUDE, because that's where the pain is obvious. Revenue only $160 million.
Yeah, and down a steep 21.6% year over year. This is the number that really caught investors' attention negatively.
And the driver was wholesale again, but much worse. Much worse. Wholesale sell-in for HEYDUDE was down 39%. And they were explicit. This is because they're cleaning up the channel, taking back returns, giving markdown allowances to retailers. So they're actively shrinking that channel right now to fix inventory problems. Sounds painful, but maybe necessary.
That's the argument. Interestingly, HEYDUDE's own DPC was almost flat, only down 1%. That was helped by some new stores they opened and doing well on places like TikTok Shop.
Okay, so that DTC near flatness is kind of a silver lining, maybe.
Yeah.
Suggests the consumer wants the product. The issue is just too much inventory floating around in stores.
That's likely the read. The wholesale channel got clogged, and now they're paying to unclog it. But despite this HEYDUDE pain, let's talk about the balance sheet.
Yeah, the capital allocation story is strong. Management really put their money where their mouth is this quarter.
They really did. They bought back 2.4 million shares, spent $203 million doing it.
At an average price around $83. And that was what percentage of the company?
That represents 4% of the entire company's outstanding shares bought back in just 3 months.
4%. That is a massive signal of confidence from management about their own stock price.
Huge, especially when you add that they also paid down $63 million in debt during the same quarter.
And they still have firepower left, right? The authorization isn't finished.
Not even close. They still have $927 million authorized for future buybacks. Plus, their net leverage is now at the low end of their target range, 1.0x to 1.5x. They have flexibility.
Okay, so strong balance sheet, aggressive buybacks. But the market is focused on the strategy and the forward guidance. Let's get into that. They talked about cost savings.
Right. So we already knew about $50 million in gross cost savings planned for this year, 2025. But the big news, kind of a bombshell on the call, was about 2026.
What did they say?
They've identified an incremental $100 million in gross cost savings that they expect to realize in 2026.
100 million more. Where's that coming from?
It sounds pretty structural. Things like organizational restructuring, really integrating the supply chains for Crocs and HEYDUDE finally, and consolidating vendors.
Okay, $100 million is a big number. But the key question is, does that just get reinvested back into marketing or trying to buy growth, or does it actually help the bottom line?
That's the crucial question. And the CFO did address it. He confirmed the intention is for this to drive operating leverage in 2026, meaning it should improve profitability even if revenue growth stays kind of soft.
So it's like an insurance policy for margins next year. They've structurally lowered their costs.
Exactly. It provides a buffer, a path to profit improvement almost regardless of the top line. That's a huge anchor for investors, or it should be.
Okay. Shifting back to the top line, especially North America, the CEO defended pulling back on promotions for the classic clog. Is that just spin for saturation?
Could be partly saturation, but they did provide a key data point. The CEO said that pulling back on those promotions actually had a net positive impact on gross profit dollars.
So fewer sales maybe, but higher quality, more profitable sales.
That's the trade-off they're making. And they're trying to diversify too, right? New clog types like Crafted Echo 2.0, bringing back the Croc band, plus pushing sandals.
And they're leaning into digital disruption, like TikTok Shop.
Yeah, they highlighted being the #1 footwear brand on TikTok Shop in the U.S. They even ran some crazy 24/7 live streaming thing in October, trying new ways to connect. Okay, and on HEYDUDE, the message was basically, the cleanup continues into Q4, but stick with us. We believe in the brand long term, pretty much. They emphasized sell-through is improving and getting closer to inventory levels, which is what you want to see. And they explicitly said they are not thinking about selling HEYDUDE or anything like that, calling it a strong-scale brand.
They have to project confidence, but the market needs to see the results of that cleanup. And that brings us to the Q4 guidance, which was cautious.
Very cautious. And that's really what hit the stock. They guided for total revenue in Q4 to be down approximately 8% year over year.
Down 8%. Ouch. After just beating Q3 revenue estimates, how does that break down by brand?
So for the Crocs brand, they expect it to be down around 3%. That's mainly driven by a continued pullback in North America, expecting low double-digit declines there.
But offset somewhat by international.
Yeah, they expect international to accelerate, actually, up low double digits. So a real split between North America and the rest of the world for the Crocs brand.
And HEYDUDE in Q4, still feeling the cleanup effects.
Oh, yeah. Expected down in the mid-20% range. That reflects both the ongoing wholesale inventory actions and also pulling back on some performance marketing spend for HEYDUDE.
Okay, so revenue down 8%, HEYDUDE down mid-20s. What about Q4 operating margin?
They guided that to approximately 15.5%. So you put that Q4 outlook together, the revenue decline, the continued HEYDUDE pressure, and you see why the market reaction was negative despite the Q3 beat.
It definitely paints a picture of near-term caution. Did they give much color on why they're being so cautious, the broader consumer environment?
Yes, the CEO talked quite a bit about that. He described what he called a bifurcated consumer.
Bifurcated, meaning split.
Exactly. He sees the high-end, affluent consumer still doing fine, financially strong, but then there's a large chunk of the consumer base, especially in those mid to lower channels where Crocs and HEYDUDE have a big presence, who are being much more choiceful, maybe a bit nervous, definitely shopping closer to need rather than impulse buying. That caution from the consumer is baked into their Q4 outlook.
That makes sense. And there's competition too, right? Especially in that under $100 shoe space.
For sure. They mentioned the big athletic brands are pushing back into those lower price points more aggressively and getting wider distribution. So it's definitely a competitive field.
Okay, so looking ahead then, what are the key things investors or just people following the story need to watch for? What are the catalysts? All right, number one, they need to actually hit or ideally beat that Q4 guidance, especially the down 8% revenue bar. If they manage that, it could change the narrative. Okay, execution on Q4. What else?
We need to see real signs that the HEYDUDE brand is stabilizing as we get into 2026. Is sell-through genuinely improving? Are they talking less about channel cleanup and returns?
Proof that the fix is working makes sense.
And number three, circling back to that huge $100 million incremental cost saving for 2026, we need clarity on how much of that actually drops to the bottom line versus how much they decide to reinvest in growth or marketing. That allocation is key for the 2026 margin story.
Got it. Q4 execution, HEYDUDE stabilization, and the use of those cost savings.
Those are the big ones to watch. They've given themselves this powerful cost lever. Now we wait to see exactly how they deploy it.
Okay, perfect time for our This Is Not Financial Advice's segment.
All right, let's pitch something aggressive, but, arguably plausible based on everything we've just discussed. So the core idea, the thesis, is basically the market is getting this wrong right now. It's overreacting to the Q4 slowdown, which is partly self-inflicted with the HEYDUDE cleanup. Necessary pain.
And it's totally overlooking the signals management is sending with the balance sheet and these new cost savings.
Exactly. You're betting on the structural strength and management conviction over the short-term sales noise. Look at the buyback.
Buying back 4% of the company in one quarter at $83.
And still having nearly $1 billion left in authorization. Management is screaming that they think the stock is cheap down here. That buyback program essentially sets a floor, or at least a strong support level. Okay, so the trade idea is basically go long CROX here, betting on that buyback support. Yeah, you initiate a long position targeting that floor. And that new $100 million in cost savings for 2026, that's your safety net.
How so?
Because even if the consumer stays weak, even if top-line growth is sluggish next year, those savings basically guarantee some level of operating leverage. They guarantee margin improvement.
So you're betting on the margin resilience driven by costs and the ongoing share reduction through buybacks rather than trying to guess the holiday sales numbers.
Precisely. Bet on the factors management controls costs and capital return, not the factors they don't, like consumer sentiment in Q4. It's a bet on structural value creation.
Interesting angle. Okay, so let's recap the whole thing. Crocs put up a really strong Q3 beat on paper, EPS and revenue way ahead of estimates.
Yep, underpinned by some real structural profit improvements, masked slightly by tariffs, and backed by massive capital return, huge buybacks, paying down debt.
But the market focused squarely on the year-over-year declines embedded in those numbers, and especially on the cautious guidance for Q4.
Right. Guidance calling for an 8% revenue drop, driven by the ongoing, deliberate, and painful HEYDUDE wholesale cleanup and some North American softness in the core brand.
Which brings us to the core tension, the big question heading into 2026, revolving around that extra $100 million in cost savings they found.
They fixed the cost structure, made it more efficient. Now they have a choice to make.
Do they let most of that $100 million flow straight through to the bottom line, really boosting operating margins and profitability?
Or do they take a significant chunk of that savings and plow it back into the business? Maybe more marketing, maybe faster innovation to try and reignite growth, especially in North America, and accelerate the HEYDUDE turnaround narrative.
That decision, maximize margin or reinvest for growth, feels like it will absolutely define the story for CROX in 2026 and probably determine how the stock performs.
It's probably the single most important strategic variable for them over the next, say, year and a half, 2 years, how they spend or save that $100 million.
Definitely something to watch closely. Thank you for joining us for this deep dive into the CROX earnings call.
Yeah, lots to think about there. We'll keep tracking it.
And we look forward to continuing the conversation with you next time.